towards resolving these concerns and helping to assure safe and sound operations at the enterprise. 4 years later, it was nationalized. The reason perhaps that things didn't change is that you'll see here from an article in USA Today, and I've just outlined a couple of the main comments in it. They had a long and illustrious history of being unable to follow the rules. Abuses that create financial trouble for either economy, this is the warning sign, they have a combined $1.7 trillion in debt, could hurt the economy by driving up interest rates and force taxpayers to pay for a costly bailout. That's just happened. Fannie Mae and Freddie Mac have a long history of resisting tighter oversight. Now, to the title of the paper. An Indian expert in the world of derivatives, Satyajit Das, is perhaps the leading authority when it comes to swaps, financial credit, and derivatives. He normally writes in language which is reserved for MIT mathematicians and rocket scientists. However, in a recent book called Traders, Guns and Money, he treats us lesser mortals to an explanation of a world where derivatives have transformed just about every feature of the financial marketplace. His examples are so entertaining and extraordinary that sometimes his book reads like a fairy tale, but unfortunately it's not. Pretty well most of what he's drawn on is from his own experience. And he describes beautiful lies as being those salesmen's lies that we as investors are told, which we know can't possibly be true, but we really do want to believe. And the world of derivatives is full of them. Common sense tells us, of course, that our clever banker cannot magically transform a boring Hong Kong dollar deposit yielding a fraction of 1% into a structured note which appears to pay several times that figure. But, of course, with all the endless talk of money in Hong Kong and the relative ease and speed with which conspicuous wealth is demonstrated these days, we can be very easily persuaded. And when added to our natural reluctance to ask questions, when we don't understand the products, and we certainly don't want to admit our ignorance of them, you've got a very powerful bomb, because something somewhere at some time will very badly go wrong sooner or later. A variation on beautiful lies he describes as true lies. He says these are the means by which we as investors actually persuade ourselves that we'll be missing out if we don't, for example, have a structured note or two in our portfolio. 15 years ago, the treasurer of Orange County in California, which was at that time the USA's wealthiest county, was managing nearly $7 billion of public money. He was persuaded by bankers to leverage it 3 times, and of the resultant $20 billion or so, 60% was represented by structured products. When challenged as to his prediction that interest rates would remain low, because unless they did, those structured products would cause him trouble, Robert Citron said, "I am one of the largest investors in America. I know these things." And this is from a man who used a wristwatch calculator to do all the analyses of transactions. Orange County shortly afterwards went bankrupt, suffering losses of $1.5 billion US. Human nature will always make us susceptible to the salesman's charms, and our love of money will always rationalize us to the merits of something which really is a seriously bad idea, but we can try and rationalize it into something which is plausibly safe. The problem today is that proliferation of derivatives renders those risks that we have in such self-delusion much, much greater. Das estimates that 70% of all derivatives now lie ticking in the hands of end-user investments like you and I. Now, Das describes how derivatives are used to pursue what he terms as regulatory arbitrage. True arbitrage is a riskless transaction where an investor is able to exploit a price difference by matching the purchase of one particular asset against the sale of a different asset. He describes regulatory arbitrage as a situation where an institution which is regulated is able to pretend that it abides by one set of rules, but in fact it conducts itself by another, or maybe doesn't have any rules to conduct itself by at all. One example deals with a French media giant, Vivendi. Now, back in 2001, Vivendi were looking to take over Canada's Seagram Group, but they were faced with a regulatory hurdle because the regulators in Europe required Vivendi, first of all, to dispose of 22% in a satellite broadcaster, BSB. The difficulty that they faced was because Seagram Group had media interest as well, and there were anti-competition issues that were raised. So the European regulator said, we'll give you the go-ahead to make the bid, but first you must dispose of your 22% in BSB. Now, in normal circumstances, that wouldn't prove to be too difficult, because in most markets, 22% isn't far off a controlling interest, and there would have been a long list of bidders for it. However, Rupert Murdoch's News Corporation already happened to own nearly 38% of BSB, and speculators in the market reckoned that very few buyers would be interested in paying market price for 22%, so they shorted the stock. Well, they were right. BSB's price fell, and Vivendi were very reluctant to sell. But, of course, to proceed with the bid for Seagram, they had to sell. Well, they got out of this mess through, you've guessed it, a clever asset swap. Vivendi formed qualifying special purpose entities to which it transferred its BSB shares and then entered into a series of transactions with the rocket scientists at Deutsche Bank. Vivendi's QSPs, this qualifying special purpose entities, QSPs, borrowed nearly £2.6 billion from the bank and simultaneously issued to the bank 5-year bonds, which were then exchangeable into their BSB shares. And at the same time, they entered into a total return swap. And they transacted this so that Vivendi retained all the economic risk attached to the BSB shares. The substantive effect of the transactions described is that the Vivendi Group has irrevocably implemented arrangements whereby the entirety of its BSB shares will be divested in due course. It doesn't know when the divestiture will take effect, nor for what consideration. So the wholly owned QSPs continued to own the shares, but Vivendi retained the economic risk attached to them. The structure of these transactions permits the transactions to be qualified under US GAAP as a true sale in inverted commas, enabling Vivendi to deconsolidate from its balance sheet the BSB shares and the debt represented by the exchangeable bonds. Now, it may have been, in quotation marks, a true sale for accountants, but I would suggest it was more like a true lie. Leave aside for the moment, and I've looked in many dictionaries, there is no such word as deconsolidate. What they meant to say was remove. Vivendi persuaded themselves that they really had sold their shares in BSB, when in fact they kept all the economic risk attached to them. Et voilà, as the French would say. And they did, because Vivendi is French. However, there's more. The accounting treatment produced an unexpected bonus, because since the true sale was struck at a price well above that for which the shares had been originally acquired, Vivendi was obliged to show a big profit for the year. Vivendi Universal believes the transfer of its shares will allow Vivendi to realize proceeds from the ultimate placement in the market over an extended period of time, enabling Vivendi to avoid receiving the lesser proceeds it would have received if it had placed all its shares in the market in 2002, as Vivendi believed the share price had been depressed by market expectations that Vivendi Universal would place all of its ordinary shares in the market in 2002. So, recognizing a profit in 2001 from a so-called sale of an asset where the sale had been achieved by means of financial engineering designed specifically to avoid the immediate disposal, precisely because that sort of gain could not be achieved in fact, and then recognized for accounting purposes. Think about it. Vivendi wanted to sell their